If you want to stay ahead of the market, you're in the right place. Today's video is brought to you by our community. Alright, what's up everybody? Welcome back to Smart Money Moves, where we break down today's stock market news, trends, and everything else you need to know in less than 5 minutes so you can make smarter investing moves. On today's episode, we're going to be covering a recent announcement from Walmart, breaking down AMC stock, answering questions about commodities, and much more. So let's jump in. Alright, let's start with today's stock updates. Shares of Walmart, WMT, are falling today after the retail giant announced mixed fiscal second quarter results. Revenue grew 2.8% year-over-year to $134.7 billion, which was above estimates of $133.2 billion. However, earnings per share came in at $1.24, missing estimates of $1.29. Walmart also lowered its earnings outlook for the year due to increasing costs. While management did raise its sales guidance for the year, investors seem to be focused on the shortfalls of the quarter, and the lowered earnings guidance causing shares of Walmart to fall nearly 3% today. Next up, AMC stock is surging again today after yesterday's announcement that the embattled theater chain has struck a deal to be removed from the SPAC list. The news seems to have calmed investor fears of a delisting, and on top of that, several analysts came out with positive commentary on AMC following the news. For instance, EF Hutton analyst Dan Kern said that while the terms of the deal will be dilutive to existing shareholders, it is the best path forward to ensure AMC's survival given the company's liquidity position. KeyBank analyst Edward Lee also commented on the deal saying, quote, "We view this as a positive as it removes uncertainty regarding AMC's ability to continue as a public company." As many of you probably already know, I personally do not like the deal either, but it does appear that this deal with Citra is the best option available for AMC. And this news has calmed investor fears enough to cause a short squeeze, with shares soaring over 20% today. And lastly, Carnival Cruise Line is facing another lawsuit claiming that the company's negligence with COVID protocols resulted in a COVID outbreak on board one of their ships. If you remember from previous episodes, I mentioned that Carnival Cruise Line had been sued multiple times for similar claims. This new lawsuit could be an indication that there will be more bad press for Carnival in the near future. Of course, this is just my opinion, not financial advice. And now on to the main portion of today's show. One of the most common questions I get asked is if I think real estate prices will fall in the upcoming recession. The answer to that question depends largely on what type of real estate we're talking about. For instance, commercial real estate prices tend to fall much harder and for a longer duration than residential real estate during recessions. This is mainly because commercial real estate is far more sensitive to interest rates and changes in the broader economy, since businesses tend to scale back or even shut down during tough economic times, which leads to higher vacancy rates and lower rental income for property owners. In fact, during the Great Recession, commercial real estate prices fell almost 40%, while residential real estate prices only fell around 30%. However, some types of commercial real estate have held up better than others during past recessions, such as industrial and warehouse space. During the last recession, vacancy rates for warehouses and industrial properties actually declined slightly, while all other types of commercial real estate saw vacancy rates rise, and this makes sense considering the growth of e-commerce. The trend towards e-commerce has been greatly accelerated by the pandemic. And with more goods being bought online, there is a higher demand for warehouse and distribution space. In fact, the Wall Street Journal recently reported that Prologis, a company that specializes in warehouse properties, saw net income rise 30% last quarter, while funds from operations increased by 14%. Prologis also reported that they have a 10% increase in rental rates and a $1.3 billion development pipeline. Clearly, this is good news for Prologis and for unit holders. But Prologis isn't the only company seeing these types of results. Rex, a real estate investment trust that focuses on industrial properties, has seen similar success with funds from operations growing by 12% last quarter. Given these strong results, it's not surprising that both Prologis and Rex are up over 30% year-to-date. And I wouldn't be surprised if these two stocks continue to perform well during a potential recession, since they operate in such a high-demand industry. So if you're looking to invest in real estate during a potential recession, consider investing in REITs that focus on industrial and warehouse properties. Just remember, this is not financial advice. Do your own research before making any investment decisions. That's all I got for you today, my friends. See you back here tomorrow.